Welcome everyone to our quarterly Outlook video. My name is Kevin DeHaad, President and CEO with CWB McLean Partners. And this quarter, I want to pick up where I left off last quarter. Last quarter, I had the great opportunity to speak with Scott Blair, the Chief Investment Officer of CWB Wealth Management. And then Scott Blair and Rick Palumbi and myself, we talked about this new, larger, enhanced research team of 15 investment professionals. And as you can see from this graphic, we went over how we're going to have specialists in each team. And so we're going to have 3 to 4 investment professionals for each asset class, and they're really going to specialize on each asset class. And we think this is really important. It's because it's going to allow us to continue to add value in our client portfolios. So today, what I want to do is I want to hone in a bit and talk about one of the teams, and that's the Canadian equity team. Now, before I get into that, I just want to give a little bit of background on the Canadian equity team. So last quarter, Rick Palumbi mentioned that Edward Friedman is going to be coming back to the international team. And Edward Friedman was managing Canadian equities here at CWB McLean Partners. And Edward had an amazing year in 2020, did a great job, and the momentum has been continuing here in 2021. However, as part of this specialization, Edward's going to go back to the international team where he actually started, and Gil Lamont is going to be taking over the Canadian equity pool here at CWB McLean Partners and working with myself and our team here on Canadian equities. Now, Gil and Edward have been working very closely the last 6 months, so this transition is going to be very, very seamless. And Gil and his team are going to be formally taking over the Canadian equity pool at the end of April. So before I start my conversation with Gil, I just want to say a few words about his background and give all of you some perspective on his experience. Gil actually started in the investment industry in 1989. And he's been managing Canadian equities for 21 years, so a long time. And he actually spent 19 years working with a company called Industrial Alliance, a national insurance company. Some of you may know them as IA Investment Counsel. So Gil managed Canadian equities there. And actually at the peak, he was managing $3.1 billion in Canadian equities for Industrial Alliance. And then not too long ago in 2019, Gil actually moved from managing this huge pool of assets at Industrial Alliance to a smaller boutique firm called Leon Fraser. And some of you may wonder how Leon Fraser fits into the picture. And I actually mentioned Leon Fraser last quarter. Leon Fraser was actually purchased in 2020 by CWB as CWB continued to expand their footprint across Canada and expand their presence in wealth management. So it's been very exciting to have Gil join us today and get the opportunity to speak with Gil. Gil Lamont, welcome to our quarterly outlook. It's great to have you here.
Thank you very much. Nice to be here, Kevin.
Yeah, and I didn't mention, but Gil is based in Toronto, so we've been working very closely together the last 6 months, but haven't had a chance to meet yet, obviously, because of the environment we're in. But yeah, Gil, I think a good start for my first question is, you're managing $3.1 billion at Industrial Alliance and Canadian equities, and then you kind of requested to go to this smaller boutique approach at Leon Fraser, obviously still managing Canadian equities. Maybe you can tell us a little bit about that journey.
Well, certainly. I really love managing money. I enjoy investing clients' wealth. And for 19 years, I did that somewhat successfully at IA in a mutual fund environment. And after that length of time, you begin to realize that you're so far away from the actual clients whose money and wealth you're managing that you feel that separation. And I felt that was really missing as a part of my level of satisfaction in doing what I was doing. And so I went looking for that closer link directly to the clients. And when the opportunity opened up at Leon Fraser, the boutique investment manager in Toronto. I requested to move there to get that closer association and direct meetings with the clients whose wealth I was responsible for. So it was a great move. It was everything I'd hoped it would be, and I'm really enjoying that that proximity to the, let's say, the end user, the actual client whose money we're investing, meeting with them, explaining how we're doing what we're doing, understanding their needs and goals, and tying that all together. It's really great.
No, Gil, that's great to hear, because I know I hear this from our clients. One of the reasons they work with us is because if they want to, they can get direct access to the research team, and that's important to them, and have that direct communication. So that fits very well with our culture and our client experience.
Yes, it's something that I think is important, and it's something that I look forward to doing in Calgary very soon.
So, Gil, moving forward, how would you describe the team's investment process and your investment process when it comes to Canadian equities? I know you and I have talked about this. We don't anticipate the portfolio. There's going to be a lot of transition, but you're still going to put your mark on the portfolio, so to speak. So maybe you could speak to your investment process, please.
Well, one of the exciting things about this whole transition is the degree of similarity between the various teams in Toronto, Calgary, and Edmonton. And on the equity side, we all have a similar approach, and that is to look at the cash flows of companies, not so much the reported earnings, but really digging down and seeing how much cash is generated by the companies, and then what they do with that cash. Now, it's that flow of cash, that stream of cash flows that really is the return to the investors. So we want to forecast that, analyze that, figure out how much that's worth, and digest that down into a valuation so that we don't pay too much for that flow of cash. Now, the cash might be streamed out to investors in the form of dividends. That's one way to see that investment. But it also may be reinvested in the company if they have investment opportunities to grow. Either way, it's still a cash flow that belongs to the investors. And so we value it the same way. And we don't want to pay too much for that cash flow. We want fair value for that cash flow. So that's the starting point, is in let's say the stock picking. The next step is equally as important, and that is to determine how much of the stock we want to own in the portfolio. And this is where we have to start balancing the risk and reward. We understand the reward with the valuation work we've done, but now there are risks that come with investing in individual companies. And that, in our world, let's say, that risk is usually measured by volatility, how much things move and how quickly they move, price-wise. Now, that's something that you can't really measure ahead of time. Volatility is something that you've measured because it's already happened. But we're building a portfolio and trying to build it so that we can reduce that volatility. So the way that we go about doing that is paying particular attention to the weight of the stock in the portfolio, the weight of the stock relative to the market. How much do we like a stock, and how much should we own, and how much is appropriate to own? And so we take a great deal of time and effort in establishing that holding, that level of risk. And once the portfolio is constructed, we do our best to either maintain that, or when situations arise that are appropriate or suitable, we may make changes to that. Every position in the portfolio is considered a core position. So we don't look at buying or selling complete holdings or companies. We want core positions in the portfolio. But if they run really ahead of themselves in a strong market, or a strong market for that particular stock, which may reflect the analysis that we've done, it's something that we expect to happen. But if it happens more quickly than we anticipated it, then we can reduce our holding or exposure to that stock. And then when it comes back or alleviates, then we would add back to it. So we have a stable of core holdings, And as they deviate, let's say, from a steady upward trend, we will take profits or we will reinvest in those same companies when they come below the line to keep them on track. And so that's the process that we use in the portfolio.
Super. Gil, that's excellent. Thank you very much. Obviously, as investors, there's two important variables: risk and return. Now,
absolutely.
At the start of this video, I talked about the new team structure, and that's really what gets me excited. Is we have 15 investment professionals working together and specializing. So can you tell us a little bit about the Canadian equity team and the structure and maybe where everybody is?
Certainly. Well, we have 3 members of the team, and we're all doing stock analysis and stock research. We have an assistant portfolio manager here in Toronto, Scott Cuthbert. He has 11 years experience, 7 years analyzing equities. And we have a senior analyst in Edmonton, Connor Barth, and he has 4 years of equity analyst experience. One thing we're doing is with respect to what stocks are being analyzed in the portfolio, each individual, myself included, has particular stocks that we are responsible for. In some cases, all of those stocks will fall in the same sector. So we have something we call sector specificity. So the analyst is the expert on the sector. In other sectors, we share responsibility. So the stocks within the sector are the responsibility of the individual analyst, but they each have certain stocks within the sector. So they're sharing knowledge of the sector. So now the benefits of sector specificity are that we can be very efficient in terms of covering the universe of stocks. As you develop expertise in a sector, you can analyze stocks there more efficiently and effectively because you understand the background environment very, very well, and you can go forward with the individual company. With respect, the advantage to sharing sectors or stocks within a sector is that when it comes time to, let's say, prove your investment thesis to the team, which is what we do, the criticism from someone who also has experience in that sector is very, very valuable. Much more can be learned in those situations with respect to not necessarily this particular company, although certainly there are elements there, but with the way the company has been modeled and the structures you're building around that model. And those can change from company to company, but may have similarities within a sector. And so by sharing sectors, there's much more learning or cross-pollination that can take place within the team. And then having the sector specificity in other areas allows us just to be more efficient, more effective in covering a universe of something on the order of 300 stocks.
Yeah, excellent, good, super. No, and I think it's important to point out that while we've had a strong team here at CWB McLean Partners, we've never had 3 people, 3 investment professionals, focused just on Canadian equities. So look forward to that. Now I got to ask you, you've been at this a long time. You still seem to have a lot of energy for it, a lot of passion for it. What do you love most about your job?
Well, Kevin, I'm outside of work. I'm sort of a builder. I make a lot of things. That's what I do. I've put addition on houses. I've built violins. I'm a maker. And whenever you're building something, it's very important to have very strong bones, very solid foundation. And I will put as much time into the things that aren't seen as the things that end up being seen at the end of the day. That foundation is really critical. And in portfolio management, that's something I take a great deal of satisfaction in. There are elements within a portfolio that may not shine the brightest all the time, but they're very foundational, and they can give confidence not only to us as managers, but to the clients and to the portfolio itself within the market, so that when things get noisy, you have a lot of confidence that the portfolio will stand its ground in those times. So that I really do enjoy that a great deal, having that or building that strong foundation. Now, hand in hand with that, or as I mentioned, the markets can be very chaotic. And that means that every day you come in, there's very often something new to learn and new to consider. What I particularly enjoy doing is observing how the portfolio and names in the portfolio react to various news items as they come out. It's important to understand not only who owns the stocks that you own in the portfolio, but what the expectations are around those stocks. And by observing how they behave, which is really a reflection of people buying and selling them, you can gain some insight or some knowledge into what the expectations were and what the expectations are, and what expectations might be being built into stocks. Now, that may not be useful information on the day that you learn that, but sometime down the road, you'll be making a decision about that stock. Hopefully, it's not whether to sell it completely or not, but you'll be making a decision perhaps on whether to add more to the portfolio. And these little elements and observations along the way will help you determine when is a good time to do that, and what expectation is already in the stock, and whether how much you may want to add to that position, or if you're trimming, how much you may want to reduce. And I really enjoy that aspect of merging the day-to-day noise and chaos with that long-term investment outlook.
Okay, Gil, well, thank you very much. I really enjoyed our conversation today, and thanks for sharing part of your journey with us. And as the world gets back to normal, I very much look forward to welcoming you in Calgary and getting the opportunity to meet more of our team in Calgary and some of our clients.
Well, thank you very much. I look forward to that, Kevin.
Well, thank you very much, everyone. I hope you enjoyed this quarter's outlook. And just like last quarter, we've attached a written commentary on each asset class that we manage by the research team. So I would encourage all of you to check out that written commentary. As always, we really appreciate your feedback, encourage your feedback. And if any of you have questions, please feel free to reach out to your client portfolio manager. So with that, I wish all of you a wonderful, warm spring. And thanks very much for your relationships, your trust, and your support.